Good evening, everyone, and welcome to today's session. Myself, Radhika Nathani, from Corporate Communication Team at IFA Global, would like to thank you all for being here on this platform. The topic for today's webinar is what is RBI stance on FX and bond markets, how to automate and digitize your business. Now, it gives me immense pleasure to introduce today's speaker, Mr. Abhishek Goenka, founder and CEO at IFA Global. Under his leadership, IFA team has catered to over 1,000 clients and has managed a FX cumulative of over 20 billion USD. Mr. Goenka is a chairman of well-known treasury forum known as Treasury Elite. So without any further delay, let's begin the session. Over to you, Mr. Goenka.
Good evening, everyone. Once again, thanks for taking out time. So time and again, whenever we have come across and whenever we have interacted, we have talked about various reasons, various factors which has moved the markets, some of the interesting observations, ideas, strategies, ROI techniques. And today is not going to be any different. And I assure you, at the end of this session, you're going to have some very, very interesting takeaways. And some of the few things that we're going to focus on is going to change your complete perspective about how to look at the overall foreign exchange and bond markets in India. So today's session is going to be broadly divided into two parts. The first part, of course, is going to be taken by me. And I'll focus on how RBI's action is so very important to understand in today's environment and how it is influencing the bond and FX markets. And the second half would be taken up by my dear friend, Mr. Venkat, who's the founder of Practus and MyCFO. And he was going to give you some very interesting ideas on how automation and digitization can actually improve the ROI in your business. And all the CFOs and chairmen who are listening to this today, I think they should better take note of this because the very interesting strategies are going to be discussed by Venkat too. And he's an expert in that field minded. So let me start once again. So as I said, we're going to focus on, I hope everybody can see the slides. My voice is loud and clear. Just say yes, yes, yes. So I know that everybody can hear me properly and they can see the slides. If there's any problem, thanks, Victor, Shiva, Ratan. Lovely. And you can use all these smileys and the laughs and the highs wherever you feel like. Let's make it extremely interactive. It's your webinar. It's not my webinar. This is made for you. So we're going to look at how does the RBI intervene in FX markets and why does it really do that? And how exports and government spending has been the key focus post-COVID. And a little bit on the RBI balance sheet and how does the reserves get transferred and why is it important to know that why the money which gets transferred, what's the maths behind it, and how does it impact the foreign exchange movements in our economy? And of course, the most important is what should you do in the current environment? Well, so before we move forward, and that's been always a pattern of our presentations, that I'll take a poll, and please feel free to put your votes. The votes are very important to all of us, and let's understand that all of your thoughts are most welcome, and it is definitely going to benefit all the viewers over here. So I'm launching my first poll. So what are the major objectives of RBI? If I have to say, please put in your answers. We'll take 1 minute. I hope everybody can see the poll. Lovely. Lovely. Thanks, Ratnavir. Thanks, Vijay. Thanks, Shobana. Excellent. I think 50% people have kind of polled. A lot of people are putting all of the above. Okay, 73% of the people says all of the above. Right. Keep polling, keep polling. More the poll, the better it is. So I'll end the poll. share the results. I hope everybody can see the results. Just say yes, yes, yes. Everybody can see? Yes. Thanks, Mahipal. Thanks, Shiva. Lovely. So as you know that this was the major objectives of the RBI, So it's not only about keeping the rupee weak, it's generally all these are the major objectives of the RBI. And in a situation last year when there was a pandemic, all these objectives together was a Herculean task for the RBI. I think I should say that this time they have done a fantastic jobs in maintaining all these objectives have been met by the government and RBI hand in hand, and made sure that we have come back to an extent quite sharply, and the numbers are actually supporting. So they've tried to keep an interest in check, kept the rupee competitive, they have kept the interest rates low, enough liquidity in the system, and of course they made sure that the fiscal issue which we were facing because of so much of money getting spent, sizable money is also going in the form of dividend from the RBI. So they have met these objectives very, very well. So the question is, why do you think that the interest rates were kept at record low and there was so much of liquidity that actually came into the system? So when there was pandemic, as you all know, what happened? I mean, we all were scared, businesses were doing stress testing, employees were not sure that they would get their salaries. There was a loss of business confidence. Consumption took a hit. Nobody wants, investment to our bhul jao. Nobody was even looking to how do they manage the cash flows for the next 3 months. So what RBI did, they did the right thing. Of course, they cut the repo and the reverse repo rates to rock bottom, and never ever seen in the past. And they increased the corridor to around, repo was around 4, reverse repo was around 3.35. And they tried to keep the overnight benchmark close to the reverse repo rate by putting in ample liquidity in the system. With the bonds left, right, and center, whatever they could do. And the kind of operations they did, you have never seen in the past. So the liquidity in the market, which used to be around, say, 1 lakh crores or something, or a neutral, went up all the way to 6, 7, 8 lakh crores. I mean, if you look at the way the liquidity just went up in the banking system, this is phenomenal. This liquidity, when you are pumping in so much of liquidity, you also run a risk of heavy dislocation, because your liquidity was supposed to be at 0, you went up to 6, 7, 8 lakh crores. Interestingly, what happened was the overnight rate or the benchmark rate, they were trying to keep it at the reverse repo rate, which was 3.35%. But actually, you'll be surprised to know that the 3-month T-bill rates were actually down below that also. So it went all the way to 2.9%. There was a 45 basis point difference between the reverse repo rate and the 3-month T-bill. But to an extent, it was giving a lot of confidence into the system also. A lot of NBFCs were borrowing cheap, and NBFC was damn scared. A lot of corporates, high-grade corporates were getting money at short-term money at 3%, 3.25%. So that way, it created a lot of confidence in the overall market. But the question is that when we were trying to bring liquidity in the system, we were trying to keep the interest rates low, the world was doing even more. I mean, how much was US printing? Anybody, any guess? How much was US printing or printing currently per month? Any thoughts? How much $1 billion? Sachin, Ratan, any idea? 120. Anand, perfect, bang on. In Europe? $120, Vikas, that's right. Europe is doing around $80 odd billion per month. So the world is printing, and where does this money go? Of course, a lot of them are going to the US stock markets, commodity markets, bond markets, but a lot of them are coming to India also. And that's what we have seen in the entire private equity, startup, equity markets. And now even started flowing in the bond markets also, So interestingly, all this money started coming into India because somehow people wanted to seek emerging market assets. And RBI had a difficult situation. Now, it's very easy. Okay, you get the money, and most of this money is hot money. You can just let the money come in, and what is going to happen? What is going to happen if the money keeps coming in and nobody does anything? How are we going to take a hit? Any thoughts? Vipul, Anand? Anand says inflation. Okay. Anybody else? As an exporter, where do you get a hit? Yes, Madan. Madan is bang on. Of course, there's an asset bubble still happening. Nobody knows. But yes, rupee will become very, very strong. Now, if the rupee gets very, very strong, of course, all our Atmanirbhar Bharat campaign, our manufacturing campaign, and all the objectives that we had, to fight against countries like China and to make India as a manufacturing hub gets majorly hit. So RBI was trying to make sure that rupee does not appreciate a lot, because we are, as a country, we don't export things which are extremely specialized, I would say. A lot of these exports are commoditized exports. So keeping rupee slightly weak is a very, very important, perspective of Government of India and RBI. So they were buying the dollars, and when they buy the dollars, they have to give rupee in the system. But the question is, the liquidity is already so how much higher? 6, 7, 8 lakh crores. More liquidity means more inflation, more dislocation. Money markets, go for a toss. The short-term rates go below 3.35. So what does RBI do? So of course, RBI has multiple ammunitions, being the big daddy. It intervenes through the forwards, so not the spot. So if you buy spot and give liquidity in the system, liquidity will increase. So what they do is they go and not buy spot, but buy forwards. That way, there is no liquidity that injection comes into the system, whereas the forward point starts going up. Now, what is the problem if the forward point starts going up? So it's not so simple that they can just, not do in the spot and move to the forward. There is a problem. What is the problem? Any thoughts? What is the problem if the forward point starts going up and RBI intervenes to sell buy? Juicy carry. Bang on, Madan. So Madan is right. The forward premium goes up, the carry increases. So you're getting from 3.5%, 4% premium, you're getting 5.5% premium. So what happens? The outside world starts taking this as an opportunity. They further start selling dollars, and there's a further pressure on the dollar, and the rupee starts appreciating. And now the RBI is pushed towards the wall that by doing a sell buy, the forward premiums are going up, exporters are selling. So this is what happened. Around this time, if you can see the orange line, which is the forward premium, the forward premiums actually went all the way to 5.5%. Now, the exporters, the people who sell dollars, know what I'm talking about. It's extremely juicy carry. And it's a double-edged sword, because there's a huge discrepancy that happens between the money market rates, which was hovering at around, say, 3.8, and the forward premium was around 5.4. So it was almost like 1.6% difference. That's a huge, huge difference. And that's not something that is a very, very good move. And often you get trapped, because this is what happens. Importers say, come on, guys, I don't want to hedge. The premiums are so high. So there's no dollar selling. There's no dollar buying happening in the market. Exporter, okay, 5.5% premium, awesome. Rupee is not going to depreciate by 5.5%. Start selling. All the large companies who want to raise ECB abroad says, okay, we don't want to raise outside money because my money is going to be all hedge basis. So let's hold on. So, and the FPIs, they start selling dollars in the offshore market, because sometimes the offshore might get slightly cheaper. At the same time, they start taking trading positions in the NDF markets to get the carry, because they say, okay, rupee current account is okay, fiscal is okay, flows are also okay, and the premiums are so high. Rupee is not going to depreciate by 5.5%. Let's sell dollars and earn that 5.5%. Even if it depreciates by 3-4%, we're going to get a 2% carry. Let's go sell $100 billion. That's the way the business was happening. So the pressure to keep the rupee afloat and not letting it appreciate becomes a Herculean task even more. So what options do RBI has? No? Now this might sound technical, but actually it's very, very important to know. Wherever you see rupee appreciation, depreciation, or high volatility in the system, the option RBI has got is when the flows come, it can absorb, give liquidity in the system. That's point number one. And then whatever system liquidity has, they can sterilize it through doing it through reverse repo at 3.3. Second option, buy dollars, give liquidity, use VRR as a tool. But the problem is in VRR is the message that goes to the market is like, there is going to be the end of accommodation or the beginning of accommodation, and RBI is going to get hawkish. But that's not the signal that they want to give in the market. And third is the rupee liquidity is managed through a sell by swap, which I mentioned. So they really took the premiums high by doing a sell by swap, maintaining the liquidity system. And as soon as they started getting little comfortable post June, July, when the growth numbers started coming in, they started observing the liquidity through the VRR route. Now, time for the second poll. How much do you think the Indian rupee has depreciated against Chinese yuan in the last 10 years? Any thoughts? Wait, let me launch the poll. I hope everybody can see the poll. Just say yes, 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 why, so I know. I hope you guys are getting the questions and the flow is fine and there's some takeaways. Just say why, in case you guys are catching it up. Lovely. Excellent. Just take 30 more seconds. Put in your votes. Lovely. Thanks, Mahesh. Thanks, Aditya. Thanks, Akshay. Thanks, Amirani. Thanks, Anand. Thanks, Anand. Thanks, Anilji. Good to see you. Ankit, Ashish, Chandni. Thanks. Lovely. Share the results. So, well, some people feel that it is appreciated against the yuan also. Nothing wrong in that. But actually, the rupee has actually depreciated by more than 40% in the last 10 years against the Chinese yuan. So what are we trying to do here? We're trying to create an artificial barrier for all the imports. And interestingly, if you go and check the numbers, in the last 5 years, whereas as an economy we have grown, our imports from China have probably been kind of flat. So it's almost the same, around $46–48 billion for the last 5 years. It has gone up and down, but then I think the focus post the recent issues we've had with China is that reduce imports, promote exports. That has been a clear focus. Now, why is this very important to know? If you see this, the Chinese yuan has been continuously depreciating against the rupee. And that's a clear message which we get that we want to keep the rupee slightly weak. And when you want to track the dollar rupee, and that could be one of the takeaways, you also try to see the Chinese yuan. And time and again, though it's never been discussed in the public circle, but we feel through our sources that somehow the central banks also keep a tab on the Chinese yuan quote against the rupee. Right now, they're trying to keep it slightly weaker than the Chinese yuan year on year. That's another important point. That's a real effective exchange rate. A lot of people would know that. It's basically a measure of whether the rupee is overvalued or undervalued. And it's been RBI's measure. They try to keep it in that range. So whenever it goes towards 104, 105, that means the rupee gets overvalued. They intervene, and whenever it's close to 100, they also intervene. So that's another way by which to make sure that we are competitive as compared to the other countries. The reserves have been going up now. a lot of people have been debating about the fact that, the quality of India's reserves are not good. You know, why are we attracting so much of reserves? What do we do about it? And to take so much of reserves, we are putting back into the US, we're not getting interest on that. And ultimately, we have to absorb the liquidity. There's a pressure on inflation, and it's a huge cost. But I'm going to show you something in the later half which tells you that increasing reserves gives a huge amount of comfort for overall investors, FPIs, the startup community, the private equity investors who are investing into India. Because when you invest into India, it's not only about the Indian bond markets and in the Indian equity markets. What is very important is how much your currency is stable. Now look at the numbers. Our current account has gone down. Your fiscal is also in control. Your foreign exchange reserves have gone up so much, $200 billion it has gone recently. You know, oil, even at 75, it's not impacting so much the broad dollar rupee. So what do you think is impacting? I mean, it's the reserves, the comfort that today the rupee depreciates, the RBI can come and hit $50, $100 billion immediately and keep the rupee in control. So I think even though it's kind of hot money, but in the last 15, 17 years, there has been maybe 2, 3 years when we have seen net outflows. Broadly, we have been receiving the net money in India. So I think reserves gives a huge amount of cushion against any kind of runaway that sometimes we have seen in the past, like 2008, 2013. Now, some of you must be in exports business here, and the point I want to mention here is that during COVID, of course, we know from these circles that personal consumption and private investments have taken a major hit. And the onerous of the growth is totally towards the government spending and exports. Exports, yes, we have been the beneficiary because of the China issue. Plus, there's so much of printing happening across the world. There's so much of demand. I was talking to my clients. They're saying now people have started shopping. The government's exports, government's demand have increased. Government have taken the onus and they have started spending so much of money. Companies are still not very comfortable in terms of doing fresh investments. And we have seen credit offtake continuously going down. Still, people are not very comfortable because of the negative output gap that we are seeing in terms of companies. And people are still not borrowing despite negative real rates. Uncertain job markets, and banks were also pretty reluctant, and their due diligence was pretty high. Interestingly, what we see from here is that in the Q1 of 21, when everything was taking a hit, the onus of spending was coming on the government. And if you see, the government numbers was around 12.7, whereas all these numbers were red. So I think government spending and export is something which is really important in today's environment. I mean, private consumption and gross capital formation is like 60% of GDP. But broadly, when they were taking a hit, even a smaller portion, what government runs around 15%, they were driving the show. So the point I want to make here is that it's going to be very good for sectors which probably is going to be impacted by the government spending. And of course, export-oriented business is going to do pretty well going forward. Now we saw that how RBI was keeping the rupee competitive, making interest rates lower, keeping the liquidity in the system. But since we know that the government now has an onus of spending, is it not very important that the government is able to borrow enough money in the market to spend? Is it not important that the interest rates at which the government is borrowing is keeping low? Is it not important that the dividend that the government gets from the RBI is being taken care of? Now, all these are very important in the current environment, and all these things actually impact foreign exchange. And that's why this is we are sharing this in this particular presentation. Now I'll take a third poll. So what do you feel is the interest cost as a percentage of central government's spending? Just the interest cost. The poll here. Please feel free to poll. I hope everybody can see the poll. Lovely. Thanks, Anil, Ashish, Chandni, Deepak, Manish, Diral, Gopal, Indamit, Harshad. Thank you all. Thanks, Yagnik, Vipul. Lovely. So of course, 38% of the participants feel that interest cost is more than 20%. Yes, it is around 25%. So interest element is so very important when we talk about the overall expenditure of the central government. So taking care of the interest is very, very important for the RBI and for the government to make sure that we are in control and our auctions go smoothly and our yields are also maintained so that the borrowing cost of the government of India is being maintained. Now, we should know that a 1% increase in the interest cost. So if a 10-year bond, which is quoting at around 610, becomes 710, around 1 lakh crores worth of money gets overly spent as cost for the next 4 or 5 years. So RBI needs to make sure that the bonds are getting bought, the yields are controlled because bonds and yields are into inverse correlation. So when you buy the bonds, yields become slightly low. And the message has to go to all the participants, whether it be banks, institutions, pseudo-government bodies, people who are buying these bonds, even the people, that the bonds yields are not going to escalate. Otherwise, nobody is going to touch the bonds. I don't know whether you remember last year when there was a huge money coming in the equity markets, whereas people were not very interested in the bond markets. And time and again, there were devolvements where the RBI they did not accept the high yields because RBI is ultimately the investment banker for the RBI, the government of India. And the first time in the history, they actually came out with an open calendar of OMOs. And they told the market that I am there. We will be there. This is our plan. We are going to buy the bonds no matter what, which gives an immense confidence to the overall market participants that if RBI is there with a plan, we can also go and buy some bonds. And ultimately, we can give it to the RBI. So it's very important to give that message to the market and make sure all these auctions actually go in a very smooth manner. Look at this number. In FY 21-22, you actually see 37% of all the gross borrowings was actually subscribed by RBI. And almost in 2022, it was 34%. Of course, secondary markets. But the market gets this message that the big daddy is behind it. So they get very comfortable. And that's why they maintained liquidity, kept interest rates low, maintained yield, kept the rupee competitive. All these things they have started doing and maintained it very, very well. And of course, all the money which was coming from outside, they have not let the rupee appreciate also. I think it's phenomenal what they have done. So a small balance sheet, a very simple balance sheet. Now, why am I showing you this? It's not because I'm taking some accounting course here, but to show you that how the dividend actually goes to the government by the RBI. Because a lot of debates happen that the dividend should go, not go. Why is the government taking the dividend from the RBI, etc. So it's very simple, On the assets, we have the foreign exchange reserves, which is the main, the RBI buy bond and they buy, US treasuries, they hold dollars. They have mark to market on these instruments. So that's the foreign exchange reserves and the bonds. And on the liability, of course, currency in circulation, which they are obligated to give, reverse repo. And of course, the most important thing that we're going to discuss here is the non-monetary liabilities, which is nothing but the equity of RBI, which consists of the cash profits, which is the revaluation reserves, which is the MTM, and the retained earnings, which is the cash profits, which typically they can pass as dividend. So in a very simple manner, if you have to understand, they have to meet two criteria by the Bimil Jalan. One is they have to provision for the mark to market, which the RBI is exposed to at a confidence of around 98%. people of statistics will understand. But basically, what I mean to say is, they will come with a number, which mota moti they will understand. This is what will take care of the market risk, and that number has to be adhered to. And the second is the contingent risk buffer, which is there for monetary, credit, and operational risk. Let's not get into detail. There are two things which they have to take into control. And if these two things have been met, they can comfortably pass dividend to the Government of India through the earnings of RBI. So the CRB should be 5 to 6% of the balance sheet. Now, in this, if you see, in the provisioning for market risk is say around 9.37 lakh crores. Contingent risk buffer is 3.98. Let's say around 13.36. Now, if the first criteria is not met, then in most of the cases, we have seen the first criteria being met, that is the provision for market risk. But the second criteria, which is a contingent risk buffer, which is often not met. So what RBI does now, this is important to know now. So whenever we feel that the contingent risk buffer is not sufficient, now so over here, the contingent risk buffer was needed around 3.98 lakh crores. Whereas the realized equity, which is like a book profits kind of a thing, which is 3.43. So then there is a problem. So how do you make sure that this realized equity goes up? Now, this is important to know, and that's where the RBI actually buys and sells dollars. Now, sometimes we say, the RBI is at 72, they're buying dollars. The RBI is at 74, 75, they're selling dollars. What's happening? This is what is happening. So whenever the realized equity is not sufficient, they need to buy and sell dollars to make sure some money is getting generated. And that money, once it is above the contingent risk buffer of 3.98, they can pass the dividend to the Government of India. So if the average, say, holding of the RBI is at, say, 58, 59 rupees on an average, the market is quoting, say, at 74 rupees. So there's a huge difference of 13, 14 rupees. So if they bought average cost of holding is 58, 59, the market is at 74, they will buy and sell at 74. So some of the profits, which was actually in the unrealized profits, which is mark to market, gets realized. And once it gets realized, they can pass that profit as a dividend to the Government of India. So once both the criteria is getting fulfilled, they can pass that particular profit. So as you can see, once the realized equity increases, the revaluation reserves actually come down, and then both the conditions are getting met, and then they can pass the money to the government. Now, this was just a little theory to understand that how they pass the dividend. But what is important is the RBI is buying and selling continuously in the market to make sure that the profits are getting booked in the realized equity. They're meeting that second criteria, and they're able to pass the dividend to the Government of India. Now, the takeaways from this is like we are now in a very, very low vol environment in the FX markets. Historically, we were doing some analysis, and we saw in the last 10 years, 15 years, we are in that 1 percentile. We have never seen such low carry and low vols environment, in the many, many years to come. So that's one very important thing that we have to take into. RBI has a clear mandate of keeping the rupee stable with slight depreciation to keep it competitive. That's the understanding I get. And there is an ample buying and selling to maintain that volatility in check, and also to make sure that they have ample money to pay to the Government of India. And the third is they are clearly moving towards $1 trillion reserves. India is in a very sweet spot. We all know we are going to attract a lot of money in the next few years. Stock markets might correct, but ultimately we are in that super growth phase. So we are moving towards $1 trillion. And I think for us to get into that MSCI bond index inclusion, making rupee more comfortable, convertible, I think is a measure in the right step. And we want to keep rupee slightly competitive against the peers. And that message we can get from the out of the money put options. Earlier, the call options used to get very expensive. Remember? Say why. But now, the put options, to hedge a put options, is actually getting expensive because there is a risk in the market that suddenly rupee just might get little appreciate. So people are not more concerned that rupee will depreciate a lot. towards 78, 79, 80. But we have that memory that नहीं हमने पहले वाले depreciation देखी है. But अभी appreciation का risk भी market में उतना ही बढ़ जाता है because of the inflows. And I'm going to show you one more data. So if you see this, because our reserves have increased and our reserve as a component of external debt has kept on increasing, our volatility for the rupee have come down drastically. Look at this orange line. Our reserves as a measure of external debt has been continuously increasing. And hence, our volatility has been continuously falling down. And that's why we can say that rupee has become much less volatile as compared to the past. And these are actual data. And if you see here, our reserves are at the money forward vols, which is the volatility which measures the risk of dollar rupee, have actually started coming down. From 2007, the vols used to hit 28, 30%. Now the vols are not even hitting around 15% lately. And lastly, the observations. So earlier when we have seen that the at the money vols used to hit 10%, 12%, 15%, 20%, mostly on the depreciation side. You see from the number from 2005 to 2021. And these three huge vols numbers. But now slowly as and when 2015 and 21 has come, that volatility numbers have come down and it's skewed equally towards appreciation and depreciation. पहले डर क्या लगता था कि रुपये वेट से depreciate ही करेगा. But अभी ये भी है कि भाई RBI जो नीचे में dollars खरीदता रहता है, if they move up, then rupee can suddenly appreciate. And that's what we have seen from 74 to 72, from 76 to 72, like that. And so the pressure on both sides. So the walls is compressed, but the action is happening in both sides. Not a one-sided runoff. Because of huge foreign exchange situation, RBI intervening in the market, things have become pretty much. So what do you do in this current environment? And that's what everybody's been waiting for. I think there's no rocket science. Simple strategies for importers. You do risk reversals, buy call, sell puts at the money spots, the money forward, and Siegel strategies. Typically in the current low volatility environment, if you run this, I think the forward premium is 4%, you will end up saving at least 1.5% from there. And exporters, important point to note is, in the last 5 years, rupee has depreciated by around 2.1%. So what you should do? You should sell dollars or not sell dollars? Say why. If you want to say sell dollars. You want to sell dollars? Say why. If you don't want to sell dollars, say no. Yeah. A lot of people say yes. Why? Yes. So it's a no-brainer. If the rupee has average depreciation is around 2.1%, the forward premium has been 4%, then obviously you're getting 2%. So if you have 1,000 crore business and you sell dollars, you're obviously going to make money. That's what been reflecting in the foreign exchange profits of most of the export companies. And imports, I think all the smart people are running risk reversals and Siegels. Forwards, 3 months, 4 months, 6 months forward doesn't make sense. So I think for importers, I think that's the best strategy going forward. So the key takeaways, and then I'll put this to Venkat, is that RBI and government is working hand in hand to maintain Atmanirbhar. They're trying to keep rupee slightly weak against the peers, maintaining interest rates and accommodation stands intact so that government borrowing goes in a phenomenal manner, and also the private investments and the confidence in the people to borrow and spend. And government finances are getting better managed, and hedging strategies, as I mentioned, run risk reversals and run carry for dollar rupee. So that's about me, and I will put this across to Venkat. And I'll give you a brief intro. Of course, Venkat doesn't need any introduction, but Venkat has been the founder of MyCFO and Practus. Hi, Venkat. Welcome to this webinar. And he runs a company with 200 people across multiple locations in the world, and have had previous experiences with large MNCs like PwC, etc. in the past. Over to Venkat, and Venkat is going to show you how through automation and digitization, you can add a lot of ROI in your business, and how he's been doing that for a lot of other companies. Yeah, so I'll take the questions later. after Venkat finishes off. So I'll put this across to Venkat. Over to you, Venkat.
Thank you, Abhishek. Is my screen visible?
Yes, Venkat.
Okay, perfect. Always a pleasure to work with Abhishek and team IFA. Thank you so much for having me today. And good evening and welcome once again to all the participants. What Abhishek and I thought we would do is to possibly share some thoughts around how automation tools can generally help in improving EBITDA and cash flow in your respective companies with a specific focus around how to automate your MIS or FP&A function. The focus is largely going to be on business intelligence tools and how it can be useful and what is the kind of ROI that you could potentially expect from a BI implementation. What I'll be doing is to share a few use cases along with some screens and also share some experiences of what were both the positive and negative surprises, some challenges and opportunities that we discovered as we went along with this journey at several of our clients. Right. So to kick off, I requested my team to put together this chart on some of the tools that we work with and we are seeing in the market. This by no means is a comprehensive list. Over the last 3 years, we have worked with about 150 odd third-party tools. What we have got here is some of the tools that we work with more often. As you can see, these tools are pretty much across the board, whether it's in the area of manpower utilization, HR, procurement management, reconciliations, whether it's bank, GST, TDS, document management systems, data analytics, materials production planning, treasury management, CRM, fixed assets, automated compliance management, expense management tools, reverse auctioning, robotic process automation, pretty much across the board, right? And increasingly, we are seeing that CFOs are really, I think, in about 95% of the cases where we're running transformation projects, we find that these are being sponsored by the CFO's office. What is it that CFOs are looking to do? CFOs are not willing anymore to kind of throw manual effort or human resources behind solving problems, because what they realize is that once you take away those extra resources, then things kind of go back to normal, and that's not an efficient way to solve problems. So I think CFOs are looking more and more ways to automate, to digitize. They want more sustainable solutions and they want more scalable solutions. So that's point number one that we see in terms of trends in CFO behavior. Second, I think the days of providing advice on time and material basis is clearly gone. I think CFOs want a clear ROI out of transformation projects. So if budgets are being approved, they require a clear ROI. From our experience, we've seen a 3 to 12x ROI in about 85% of the cases that we have worked with CFOs, right? But the business case for why the CFO should be embarking on any kind of automation or transformation agenda needs to be defined upfront. And that's now almost like, I would say, virtually all the CFOs that we work with insist on that. The third aspect is, I think, the tolerance or patience for long drawn implementations is clearly gone. You know, the days when you could do a 12-month, 15-month ERP implementation, etc., is gone. The good part is that today there is a plethora of tools that is available in the market. These are all SaaS cloud-based models, pay as you go. You pay a license fee per person per month, and you begin to kind of see a go live within, say, about 4 to 8 weeks time. And CFOs are able to see actual results on the ground in about 6 to 10 weeks time, right? So clearly the preference now is to look at short cycle projects that can deliver measurable impact. Yeah? So that's kind of broadly what we are seeing in terms of user behavior on the CFO side. The other very good aspect that we are now seeing is that affordability of tools has just improved tremendously, right? So earlier, you touched anything on the BI side, and for those of us who have worked with large companies who are trying to sell to us like SAP or Oracle, I mean, they're just crazily expensive. But today there are some very, very affordable tools available in practically every segment, right? Whether it's BI or even say budgeting and planning, which again we'll talk about very briefly. But even things like robotic process automation, which was like largely dominated by overseas players like say an UiPath or and automation anywhere or Blue Prism. For instance, we work with a local vendor called Nvidius, and we find them to be extremely cost competitive, without of course compromising on the quality of the output. So in terms of the affordability of the product today, the good part is that there are tools that will suit all kind of budgets and all kind of pockets. So I think, it's almost like going to a supermarket and finding different varieties of SaaS tools that can kind of solve a variety of problems at different price points, depending on what your budget is. Yeah, so with this as an overriding kind of comment, I will probably kind of do a bit of a deep dive now into some of the BI tools and what kind of impact one can expect from them. So this is a use case for a company that's about $1 billion in the textile business. They are a B2C brand with operations in both India and overseas, largely built to stock kind of a model, but across different, there's a lot of complexity in terms of the product mix and the number of SKUs that they manage. And because they're very global, there are supply chain complexities as well, particularly around demand forecasting and around material planning, right? So I'll talk a little bit about how we were able to help them with the inventory management through this project, right? What I'd like to do is to really kind of focus a little bit on the right-hand side of this slide. The ROI that we were able to deliver on this project was about 25 times is the return. 25x of the transformation spend is the kind of return that this company was able to get from the transformation spend, and the project is still not over. I mean, there's still some way to go in terms of completion. It's about 70% complete at this point, right? So if you look at the right-hand side and the sections in green, which kind of quantifies what the impact is. So one of the biggest beneficiaries of these kind of projects, especially on the BI side, is that finance stops to do consolidation of Excel. Right, because all the reports are kind of coming straight out of the BI tool. It is a self-serve model, which means that nobody's kind of chasing finance for reports. They can go and take a look at it whenever they want. B, there is no dependence on month end, especially for the operating metrics like say sales or volume analysis or price movements or salesperson productivity or inventory levels or the status of your schemes and themes on the distributor side. Pretty much, the respective departments can kind of go and log into this system and see the reports for themselves without having to wait for a month end, without having to be dependent on finance, right? Now, what the biggest beneficiary of this is that finance stops to become a data provider and it becomes a data analyzer. So from a standpoint of helping not only performance monitoring, but actively and proactively driving performance measurement is where the biggest benefit of the BI tool really begins to kick in, right? So we were able to attribute about 2% improvement to sales, purely arising out of real-time data being available to the sales heads of their salesperson performance. They're able to not only see the person level performance, they're also able to see store level performance, they're able to see marketing scheme or campaign level performance. And by just the ability to kind of take corrective action faster, we were able to improve sales by about 2%. And if you take a gross margin of about 35%, which is kind of typical in the business, it gives you a 20 times return on the transformation spend. The other thing that it helped to do is an improvement in the inventory levels, because this is now available pretty much across the board real time. For instance, because a sales manager knows as to what kind of inventory is not moving, you are able to take decisions around, say, liquidation of inventory, maybe through a marketing scheme, maybe through a discount. But those decisions happen faster, which means that your cash turns become that much faster. So this lowered working capital and release of cash flow into the system. It improved. It gave a return on investment of about 4 times on the transformation spend. And finally, the last thing, which is a fairly small thing in the overall scheme of things, but it's a big deal for the finance department, is that the total time that the finance folks were spending on consolidating and generating and publishing these reports, it came down significantly, which gave about a one-time return on the transformation spend. So just purely out of the salary cost attributable to the time saved by the finance team itself kind of paid for the entire transformation cost in this particular kind. Everything that happened on the business side was pretty much a bonus. As I mentioned, it's about a 70% completed project. I mean, when you say 70%, it's kind of, we are taking independent geographies and functions here. So the locations being covered are US, UK. There are 3 Indian factories, the corporate office, as well as all functions: sales, inventory, procurement, costing, finance, and commercials. Right now, we'll quickly kind of go into some of the screens, and I don't intend to kind of spend a lot of time explaining every screen. That's not really the objective of today's presentation. But really, for me, the key takeaway here is, pretty much, if you are a lover of statistics or data, then I'm sure you're going to love a lot of this, because pretty much, comparison across different data dimensions, right? Which is for the month, YTD, current month, current year versus current month last year, actuals versus budgets, actuals versus forecast. Pretty much everything is kind of available on the screen. You're able to kind of analyze the sales by business segment, by zone. You're able to see the average monthly sales, the sales by product category, the sales by customers, to be able to see customer concentration risk. You're able to see even last 4-week average sales. So if you want to kind of look at the sales momentum and come to some conclusions, you are able to kind of see that as well. And obviously, the good thing about this, it's all available in a graphical format, right? Which is, I'm sure finance guys will definitely appreciate this, but the biggest fans of a report like this is folks on the business side, right? So the sales guys or the manufacturing guys, they just love these reports because it becomes very intuitive. They don't need somebody to kind of interpret the numbers for them. They're able to kind of see this, and through smart use of color codes. So if you kind of look at the green triangle on top, or the on the top section of the screen, or if you look at the red triangle on the top right of the screen, it's very easy for someone to kind of understand whether I'm doing well or I'm not doing well, right? So similarly, this kind of now goes into a lot more detail in terms of the color-wise sales, category-wise top programs, size-wise sales, theme-wise sales. What we have been able to do here is also to integrate collection reports, and this is a typical problem for the CFOs, where sales teams will go out and sell, and then you got a deteriorating AR report because collections are not happening on time. So what we did is to kind of integrate the collection report as a part of the sales report itself, so that the sales head and all the reportees into the sales department are able to see what is the status of collections. Right. We have also been able to do a year-on-year growth, and this is kind of at an outlet level. So because they are able to sell, say, through Shoppers Stop or Big Bazaar or a More or a Metro Cash and Carry or whatever, you're able to kind of see that performance. You're able to also take a look at the by category, which is, if you look at the specialty stores, value format, impulse. So this is by type of retailer stores as well. You're able to see the performance, right? I'm going to kind of quickly move through this. Now, these are some productivity metrics that we kind of came up with. And obviously, in every business, the productivity metrics will be a little different. Here, we came up with metrics to say that, look, what is the correlation between the sales that is being generated at a store vis-a-vis the square footage or the area occupied by the store? And are there any learnings coming out of that, right? So, which are the stores that are offering you the best value for money in terms of the best revenue per square foot or space occupied? So these kind of productivity metrics are also possible to be mapped into the BI reports. It also gives you a good idea about, this is really more on the salesperson side. So where are people with regard to their annual targets? Who are your best performing guys? Who are your worst performing guys? If you look at the bottom right hand side, we also provided a report called the year to go analysis, to say that, look, the blue bar is where you are, which is your current run rate, and the remaining target is what is there in the light blue, right? So very clearly, it's an exception report, and it becomes very easy to kind of, if there is a gentleman called Biplab Das, who's kind of badly lagging behind, it's very easy for you to kind of communicate, or even for him to kind of see that if he's going to continue on the current run rate, he's not going to be able to get to the numbers. So corrective action in terms of addressing areas of non-performance becomes much easier. And of course, the whole idea here is that the CFO or the finance office doesn't really need to be a policeman who's kind of trying to drive these changes or improvements. I mean, it's provided as a dashboard to the department heads. Pretty much, the results are kind of staring at them on their faces, and they're able to kind of take these actions fairly quickly, right? Now, obviously, the important thing in all of this is regular updation of the system. And the one thing that we recognize is that even in this webinar, there are probably companies at different levels of maturity with regard to data definition, accuracy of punching data on time, how well the data points can be brought together into a report, whether this is in a graphical form or an Excel form, what is the frequency of publishing, what is the rigor of the reviews, etc. But the biggest learning for us has been that a BI journey is not really a one-off event. It's a process, and it takes some time. And even in this company that we're talking about, it's an 18-month process that we are running. But over a period of time, what we've seen is disciplined action and disciplined fine-tuning and improvement of these reports can really generate wonderful returns if companies are really serious about their transformation project. Right now, obviously this can be structured at various levels, right? What we saw earlier was really more at a maybe a head of sales kind of a level, but then you can kind of easily go into a store level analysis and even things like, say, sales velocity per store. If you look at the central part of the screen, there is something called number of stores with no sales by color. So if there are some items or SKUs that are not moving in particular stores, then should we be kind of moving this to a different store, or should we be doing some action in order to get rid of it at the store? So, inventory levels kind of significantly come down. Obviously, this data also gets fed back into supply chain and to manufacturing so that they can then take a decision as far as procurement is concerned. So while a lot of this is kind of impacting the finished goods inventory, at some point it begins to also make an impact on the raw material inventory that you're currently holding, right? So store level sales and gross margin. So obviously a huge area or use case for this is the benchmarking. So this can be used both for internal and external benchmarking. External, provided the data is available, but internal benchmarking is something that is completely in your control. Again, so again, it depends on what your unit economics looks like. But for folks who have got a store-based or an outlet-based kind of a business model, extremely handy in terms of being able to benchmark and decide which outlets you need to kind of put on a correction plan, and also what are the best practices that some of the better performing stores are doing that you could possibly take and cascade across all other stores, right? Similar for inventory, and this kind of takes into account both inventory turns and days to kind of measure what is the efficiency of your inventory management. Also, it takes a look into what is the aging. If you look at the top bar, it kind of talks of the aging of the inventory, which also gives you a pretty good handle. Like in this company, for instance, above 9 months, there is about 11% stock. Right, and 9 months into the project, I mean, this is one of the more dated reports. We were able to bring that 11% down to something like 4%, right? Just because there is increased visibility, there is no place to hide. You see this data every day, and people take corrective actions based on that. Yeah. So a typical dashboard today each dashboard takes about a week to develop. The good part is that there is enough talent that is available. The most popular tools that we see just from a product standpoint is Power BI. We see Tableau, we see ClickView, ClickSense. I think these are probably the top 4 that we see across geographies. And on the service provider side, which is people who can kind of come in and design the dashboards for you from a technology standpoint, there's plenty of talent out there that is available and fairly competitive, right? So each dashboard, as I said, should typically take you about 7 to 10 days to design and implement, right? Similar dashboards now on working capital. Kind of gives you your AR, receivable, how much is outstanding from date of invoice, from the expected date of payment, etc. Red flagging of cases where it's overdue and you don't have any let's say guarantees or any other instrument that kind of assures the payment. So how much is your open exposure by aging? So pretty much all this is available. This is now on the core financial dashboards, which is really on sales, gross margin, contribution, EBITDA. All this is at a company level now. Again, I'm just going to quickly breeze through this, just let you visually kind of get a eyeful of some of these screens. Right. Again, at a CEO level, makes it extremely easy to review, right? I mean, this single screen, for example, talks about return on capital employed, what's the debt equity ratio, equity ratio, what's the contribution, EBITDA, fixed cost ratio, something that, the stuff that the CEOs need to see. And if you look at the it looks like a little bit of a watermark. The stuff in both red as well as green kind of gives you a sense of what is the trend on that particular parameter. Right. What we thought we would do is to also spend maybe 2-3 minutes, and we'll obviously hold then for Q&A for some tools that can be used for budgeting. Right. So we see that reporting of actuals using BI tools is fairly relevant, but we don't see that much automation of budgeting and forecasting. We'll see, I think 95% of the companies that we work with still continue to kind of use Excel to do that. And we went out to the market to kind of see what are the tools that could be made available to companies to automate budgeting and forecasting. And what you will see here are screenshots of a company called QuarkCube that we work with. There is another tool called MyGuide, which is a slightly cheaper tool to work with. But we just love these tools, because they allow you to actually define the assumptions, right? And these assumptions are being defined at a business driver level. So when you start the budgeting, you're not kind of really taking this last year's numbers and taking some kind of an increment on it, but you're really asking the sales teams and the procurement teams and the planning teams to actually start with the assumption. So it's pretty much kind of grounds up, bottoms up budgeting process. So if you look at the parameters here, you will see that there are budget drivers, and then there are allocation drivers, and then you kind of define which department owns each of these factors. Right, and what it does is that as you keep changing the parameters of the budgeting. So let's say you would say that, look, I want my month. Let's say you're planning out seasonality for the entire year, and you say, look, let me model the forecast for seasonality based on past trends of seasonality. And then you may say, hey, look, there are some factors this year because of which my seasonality changes, right? And then you may say, look, in this month, let's say October. If every year Diwali was 120%, this year it's going to be 150%, let's say, because of pent-up demand kind of coming back after COVID, etc. You make that change, and then the entire plan automatically changes right in front of you in the same screen, right? Which is sometimes difficult to do in Excel because you're kind of making the changes in one place, and then you don't know where the formula has really gone, and the outcome could be in a different sheet. So it's very hard to visualize, and of course, it's all numbers. Whereas here, you can actually see the outcomes on the screen as you make these changes, right? What this also does is it allows you to kind of do forecasting. So after you're done the budgeting, which used to be, which probably still is a once in a year kind of an affair, but just given the level of business uncertainty, I'm sure many of us are now doing forecasts practically every month. Right. And so if you want to do something like that, Excel has got some limitations. So a tool like QuarkCube can actually help you to keep revising these forecasts in a much more efficient manner. And there's also a trail to kind of say, okay, what are the assumptions that have got changed over a period of time? So if you look at planning as a function, how do we kind of evolve further? Something like this, a tool like this can be extremely powerful to kind of get the company together, all departments together, in terms of aligning as to how is it that we are seeing the business progress going forward, right? So the whole point here is, how do we get the CFO's office less focused on analysis of the past, doing a postmortem, and then trying to extrapolate the future, versus can you actually show the management, the board, the CEO, what the future is likely to look like? Because once it is put up, then there is a base document based on which people start to ask questions and saying that, look, if this is what the future looks like, okay, based on what our assumptions are taken, what can we do to either improve the outcomes further, or B, what can we do to improve the certainty around the outcomes that we are currently seeing on the screen, right? So, which is where I think the value of a tool like this really comes up, right? So I'll halt here. I mean, there are, as I said, there are several tools, and we are just kind of looking only at the area of MIS and budgeting. To quickly sum up, I think the key takeaways are: it's getting more and more graphical. It's moving away from tabulated numbers. B, it's getting very participative. I think we're now democratizing numbers and making it available to folks well beyond finance. C, the CFO's role now, the finance departments are no longer kind of sitting and consolidating Excel sheets. They don't need to do that. I think it's pretty much self-serve. It's not linked to the month end. It's pretty much real time. It's very affordable, and it offers you phenomenal ROI, and you should be able to start seeing paybacks within, say, month 3 to month 6 of the implementations. Yeah, so with those words, once again, thank you, Abhishek, for this lovely platform and opportunity, and very happy to take questions if there are any.
Lovely. Thanks, Venkat. It's been very, very interesting snapshots that you have shared, and I know Venkat personally, so where it's a significant value to a lot of our companies also, and they have benefited a lot. So in case you guys are struggling with MIS or dashboards or some performance improvement, then probably 10 to 15% EBITDA addition is probably what Venkat could add. So feel free to get in touch. Anyways, open for questions. So questions on the overall performance improvement or anything with regards to the first part of the webinar with regards to FX and bond markets and how it's impacting. Feel free to put the questions and our team be happy to answer. And we and Venkat are obviously there. We'll take this for 10 minutes. Feel free to put in questions.
I actually see a couple of questions, Abhishek, on the
if it's yours,
panel.
Please take it.
Yeah, I'll probably answer the second question, whether these dashboards have been built by MyCFO. So the answer is yes, all these dashboards have been built by us. Obviously, they are co-created with the client. What we would typically do is once we have understood what the business of the client is, then we would kind of go away and based on when we work with about 600, 700 companies. So we are able to kind of tell them that, look, these are the KPIs or metrics that will be useful for you to review, right? And this would typically get designed on an Excel spreadsheet. So it's what we call as a wireframing exercise. Where we tell them not only what are the parameters that they should be reviewing, but also the form or the view that they should be looking for from the tool. Obviously, that kind of undergoes a process of review and approval with the client. And once it is ready, then we would kind of turn it over to the technical team. See, increasingly, a lot of this work is kind of being moved in-house, okay, but we also work with technology partners. I mean, if there is some kind of a coding that is involved, then obviously we would kind of bring those firms in. But as far as a client is concerned, it's a single stop solution, right? So when we provide a scope of work along with what are the deliverables and the costs, if there is any third party involvement required, that's pretty much kind of baked into our timelines, costs and deliverables. Yeah, we do use ClickSense as well. So as I said, I mean, we use a variety of tools. So, if you need a little bit of an insight into what are the pros and cons of working with these different tools, very happy to kind of set up a time with my pre-sales and technology team. They'll be very happy to kind of walk you through at a high level what are the pluses and minuses. Yeah. Abhishek, there is a question from Mahipal Soneja. Would you like to take that?
Well, Mahipal, track our social media channels. We keep posting a lot of interesting stuff on LinkedIn and keep following our market reports and otherwise there are a lot of foreign exchange websites also which you can track to get some interesting. There are some writers like Kathy and all that they write well. Kathy Lee, you can track them also. So that's it.
Yeah, I see a question on whether there are any tools for accounts receivable review. So yes, there are. I will probably need to kind of check with my team for specific names, but more than happy to. Yeah, it's kind of come as anonymous attendee, so I'll probably need to. You can probably ping me, or you can probably ping Abhishek or anyone in the IFA team. With your contact details, happy to actually get back to you with names of specific tools. But we have seen 3 or 4. So one is there are automated reconciliation tools that kind of send out your account statement, and there are ways to kind of extract the data, reconcile it, send it back if there's a lot of volume of transactions. B, there are automated confirmation tools that are more useful from, say, an audit standpoint. And 3, of course, is that from an AR reduction standpoint, there are some tools as well. So happy to share some more dope on it. Please do leave your coordinates with one of us, and we'll be sure to get back to you.
Yeah.
You can see a question from Deepak Sharma on interface with SAP. So definitely possible. In fact, if my colleague Nikhil is joined, I would probably want him to take this question because he's much better qualified than me to answer this. But these BI tools, they sit pretty much on top of all the ERPs. And in fact, all the dashboards that you just saw in the presentation today are all have been built on top of SAP, Deepak.
Yeah.
Right?
Hi, Venkat sir. Hello, everyone. Nikhil this side, so the dashboards that have been shown in the seminar, we have been developing across a particular time and taking on a few questions over here. I would, like to answer how dashboard is maintained and can this BI take information from different sources? So the answer to this question is, the first question is, can this BI take information from different sources? Yes. So for example, if you have SAP at your end, if you have Tally, or if you have a QuickBook or maybe Zoho. So there are different set of connectors available in the market. Connectors are some IT tools which are connected to these data sources, and they push your data into a data warehouse. So warehouse may be, for an example, a SQL. If Zoho as in maintains, at a SQL level the data, then we don't need to use the connectors. So for different sources and different databases, yes, we can collect all the data into a particular data warehouse, and that data warehouse can be used to build all these dashboards, and it can be, being effectively made. Yes, moving on to another question, how is the dashboard maintained? As answered, really, we maintain a data warehouse for multiple sources of data, and from that data warehouse, we are using all the data to build out the matrices on a particular tool like Power BI.
Yeah. So I think Umang, probably Nikhil has already answered this, but just to clarify and just amplify that point. So we have situations where, let's say, information has to be pulled from a POS system, from a CRM, from an ERP, even from Excel tables, right? So we have been able to successfully integrate all of this, pull the data into the data warehouse, and then generate the BI reports. So the answer to that is definitely yes.
Yeah.
Okay.
Great, Venkat. I think that was a wonderful session, and I think once again I would like to thank you all for being here, and I wish you, your family, your office, your factory colleagues, very comfortable environment to go by, and wish you guys a great weekend. Enjoy with your families and your kids.
Yeah. Abhishek, very quickly, there are some more open questions. I don't know, have we run out of time for the webinar?
Yeah.
Would you like to close it?
Yes.
Or we want to kind of take those questions?
So, which one
I can
is
see a question from Anand Balkrishnan where he is asked about the Bitcoin impact on currencies. And there are a couple of questions on BI from Umang Patodia.
Okay. So Umang is a dear friend. Probably we can take that offline with Umang, but in case you want to take Umang's question, please take it. He's a client and a dear friend.
Right. Yeah, I can see something from Anand also. Yeah, so Anand, I think on your question of whether we have a tool that uses Python to scrub data and leads for sales enterprise from website. So I think there are multiple tools available for scrubbing data. Some are Python based, some are not. Okay, but maybe this will require a little bit of a deeper understanding of what your specific use case is. But happy to kind of connect with you to understand this, and definitely we can use automation to scrub the data for sure. Yeah, now I think your question is probably more from whether this can kind of act as a crawler and pull leads from the website is, I think, generally what I'm getting from this. So let's talk about it as we go along. Umang, again, I think your question on whether this BI of SAP, how does it compare with third-party BIs? I think, I think, again, I would like to understand a little bit more about what's your specific situation. What we are really seeing is that unless your needs are really complex, okay, I think Power BI is probably our recommended option as far as BI is concerned, because very flexible, it's very intuitive, and it's got a very short implementation life cycle. But again, maybe we should kind of connect to understand your specific situation, right? I am just wanting to make sure that we're not missed anything. Yeah, I think that's about it. Abhishek, thanks for just allowing that extra 2 minutes.
And in case you want to get in touch with Umang, I'll pass on the number. You can talk to Umang.
Sure.
And he's a savvy guy for ERPs and dashboards. I know that for sure. Please, good to see you all once again. Thank you. Have a lovely weekend. Thanks, Venkat. Thanks everyone once again. Bye.
Thank you. Thank you all. Thank you, Abhishek. Bye-bye.